Hello and welcome back to Explain the Charts. Today is October 5th, 2025, and we are diving deep into one of the most watched currency pairs in the world, GBPUSD, also known as cable. In this video, we'll break down the crucial news events driving the market and then meticulously analyze the charts to identify key levels and potential trade setups. First, let's talk about the macroeconomic landscape, which is currently a fascinating tug-of-war. The biggest story right now is the ongoing U.S. government shutdown, which is creating significant uncertainty and putting downward pressure on the U.S. dollar. This shutdown has even delayed key economic data releases like the September non-farm payrolls, leaving investors in the dark and forcing them to scrutinize other indicators like the ISM Services PMI. This short-term dollar weakness is providing some support for the pound. However, looking at the bigger picture, there's a strong fundamental divergence between the two economies' central banks. The Bank of England, led by Andrew Bailey, has been sounding more hawkish recently, expressing concerns about persistent inflation in the UK, which makes rate cuts less likely in the immediate future. Conversely, the US Federal Reserve is signaling a more cautious approach, with markets pricing in a high probability of rate cuts in 2025, especially given some weaker-than-expected jobs data in previous months. Adding to this, the new Trump administration's protectionist policies are broadly expected to strengthen the U.S. dollar in the long run. So we have a conflict: short-term U.S. dollar weakness from the shutdown versus a longer-term outlook of monetary policy divergence that favors a stronger dollar and thus a weaker GBPUSD. Now, let's see how this narrative is reflected in the price action on our daily chart. Looking at the full picture, we can see a very strong bullish run for GBPUSD starting in early 2025, where the price climbed from lows around 1.20 all the way to highs above 1.37 in late June. After this peak, the price entered a period of consolidation before establishing a new high in mid-September around 1.37. This level acted as a major resistance point, marking the start of a significant reversal. The price has been in a clear downtrend since that September peak, which aligns with the growing narrative of central bank policy divergence. Let's zoom in on the action since September to get a clearer view of this recent downtrend. As you can see, after failing to hold above 1.36, the selling pressure intensified. We saw a dramatic drop just a few days ago, on October 3rd, where the price plummeted over 100 pips in a single day, breaking below several support levels including 1.33 and 1.32, to a low near 1.31. This was a significant bearish breakout, indicating strong momentum to the downside. Since that major drop, the price has been consolidating in a tight range, which is what we are seeing today. This consolidation could be the market pausing to digest the recent move, or it could be a result of the short-term dollar weakness from the government shutdown preventing an immediate continuation of the sell-off. Let's switch to the 1-hour chart to analyze this recent consolidation more closely. Here we can see the price action following the big drop on October 3rd. The price has been trading in a range roughly between 1.3400 on the low end and the 1.3500 area on the high end. A key resistance level, as noted by many analysts, is forming around 1.3471, a level that has been tested multiple times in the past. Breaking above this level and subsequently the psychological 1.3500 mark would be the first sign of a potential bullish recovery. On the downside, support is currently being found around the 1.3400 to 1.3410 area. A break below this level would signal a continuation of the bearish trend, with the next logical target being the recent lows around 1.31 to 1.32. Now if we look at the 15-minute chart, we can see the intraday price action has been quite choppy, moving sideways without clear direction. This reinforces the idea that the market is in a state of indecision right now, caught between the conflicting fundamental drivers we discussed earlier. For day traders, this means watching for breaks of the immediate range highs and lows for short-term opportunities. The lack of momentum suggests caution until a clearer directional bias emerges. So, let's recap the key levels and potential scenarios. The major overhead resistance is at 1.3471, with a more significant psychological barrier at 1.3500. Immediate support lies around 1.3400. Below that, we have key support levels around 1.3350, 1.3200, and the recent low near 1.3100. So, what are the likely outcomes? First, the bullish scenario. If the U.S. government shutdown continues to weaken the dollar and the price breaks and holds above 1.3500, we could see a push towards 1.3550 and even 1.3600. I would place the likelihood of this short-term recovery at about 40%, as it fights against the stronger long-term bearish fundamentals. Second, the bearish scenario, which aligns with the longer-term trend. If a resolution to the shutdown is announced, strengthening the dollar, or if price breaks below the 1.3400 support level, we could see a swift continuation of the downtrend to retest the 1.3200 and 1.3100 lows. Given the powerful downward move we just witnessed and the overarching policy divergence, I see this as the more probable outcome in the medium term, with a likelihood of around 60%. Finally, we could see continued sideways consolidation between 1.3400 and 1.3500 as the market waits for a new catalyst. Keep a close eye on any news related to the U.S. government shutdown and upcoming ISM data, as these will be the primary drivers in the coming days. Thank you for watching this analysis on Explain the Charts. Before we go, please remember that this video is for informational purposes only and should not be considered financial advice. Trading involves risk, and you should always conduct your own research before making any investment decisions. Don't forget to like and subscribe for more in-depth chart breakdowns.